Have you ever wondered why so many people seem to lose money in the stock market, even when it feels like everyone else is getting rich? It's a frustrating experience, and you're definitely not alone. The truth is, most amateur investors make a few common, costly mistakes. But the good news is, once you know what they are, you can actively avoid them. So today, we're going to break down the top reasons people lose money investing and how you can flip the script to build wealth successfully. First, let's talk about the biggest culprit: emotional decision-making. We're all human. When we see our stocks soaring, we get greedy and want to buy more, often at the peak. And when the market tumbles, fear kicks in, and we panic sell everything at the bottom, locking in our losses. This cycle of buying high and selling low is the absolute opposite of what you should be doing. The legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." It's simple advice, but incredibly hard to follow in the heat of the moment. The key is to have a solid plan before you even start investing, and then stick to it, no matter what your emotions are screaming at you. Another huge mistake is the lack of diversification. You've probably heard this saying, "Don't put all your eggs in one basket." This is investing 101. Yet, so many people get excited about one single stock, maybe it's a hot tech company or a friend's can't-miss tip, and they pour all their money into it. This is incredibly risky. If that one company hits a rough patch, your entire portfolio goes down with it. Proper diversification means spreading your money across different asset classes, like stocks, bonds, and real estate, and also across different industries and geographic regions. Think of it like building a sports team. You don't just want one star player. You want a full roster of skilled players in different positions to handle any situation the game throws at you. This brings us to our next point: chasing hot tips and get-rich-quick schemes. We're constantly bombarded with stories of people who made a fortune overnight on some obscure crypto coin or meme stock. It's tempting to want a piece of that action. But for every one person who gets lucky, there are thousands who lose their shirts. Chasing these trends is not investing. It's gambling. True investing is a long-term game. It's about buying into solid, well-run companies with strong fundamentals and holding them for years, allowing compound interest to work its magic. So, next time your cousin's friend tells you about the next big thing, just smile, nod, and stick to your long-term strategy. Your future self will thank you. Let's also address trying to time the market. This is the idea that you can predict exactly when the market will hit its peak to sell and when it will hit its bottom to buy back in. It sounds great in theory, but in reality, even the most seasoned professionals on Wall Street can't do this consistently. The market is influenced by countless unpredictable factors, from economic reports to global events. People who try to time the market often end up sitting on the sidelines with cash while the market goes on a bull run without them. Or they jump back in too early and catch a falling knife. A far more effective strategy is something called dollar-cost averaging. This just means you invest a fixed amount of money at regular intervals, say every month, regardless of what the market is doing. This way, you automatically buy more shares when prices are low and fewer shares when prices are high. It takes the guesswork and emotion out of the equation. Another major pitfall is not doing your own research. It is so easy to just follow the crowd or invest in a company simply because you recognize the name. But do you actually understand their business model? Do you know if they're profitable? Do they have a lot of debt? These are crucial questions. Before you invest a single dollar, you should do your homework. Read the company's annual reports, listen to their earnings calls, and understand their competitive landscape. You don't need to be a financial analyst, but you should have a basic understanding of what you're buying. Investing in something you don't understand is a recipe for disaster. You wouldn't buy a house without inspecting it first, right? Apply that same diligence to your investments. High fees can also eat away at your returns without you even noticing. Many actively managed mutual funds and financial advisors charge high management fees, sometimes 1 to 2% or even more. That might not sound like a lot, but over decades, these fees can consume a massive chunk of your potential profits thanks to the power of compounding in reverse. Imagine you have $100,000 invested. A 2% fee is $2,000 a year, every year. Over 30 years, that adds up to a staggering amount of money that could have been in your pocket. This is why many investors are now turning to low-cost index funds, or ETFs. These funds simply track a market index, like the S&P 500, and typically have extremely low fees, allowing you to keep more of your hard-earned money working for you. Finally, one of the most common reasons people lose money is simply having unrealistic expectations and a lack of patience. Investing is not a sprint, it's a marathon. You're not going to double your money in a year. True wealth building takes time, consistency, and a whole lot of patience. There will be good years, and there will be bad years. The market will go up, and it will go down. The key is to stay invested through the volatility. If you look at any long-term chart of the stock market, it's a clear upward trend, despite all the scary drops along the way. Those who get spooked by short-term dips and pull their money out miss the inevitable recovery and the subsequent growth. So set realistic goals, be patient, and trust the process. So, to recap, the main reasons people lose money are making emotional decisions, not diversifying, chasing hot tips, trying to time the market, failing to do their own research, paying high fees, and being impatient. By understanding these pitfalls, you can actively avoid them. Create a solid, long-term plan based on your goals and risk tolerance. Diversify your portfolio across different assets. Invest consistently through dollar-cost averaging, preferably in low-cost index funds. Do your homework on what you're buying, and most importantly, be patient and stay the course. Investing isn't about being the smartest person in the room. It's about being the most disciplined. With the right mindset and strategy, you can avoid being part of the statistic and instead build a secure financial future. Thanks so much for watching. If you found this helpful, be sure to hit that like button and subscribe for more content on smart investing and personal finance. See you in the next video.